Omaha. In each case, Buffett took a percentage of the gains beyond a certain return threshold, which is called the interest provision. Generally, when he took more of the risk himself, he took a greater percent of the overage. Across the 11 partnerships, the interest provisions ranged from 0% to 6%, after which the excess to the general partner kicked in. The earliest partnership had a loss-sharing provision where Buffett agreed to personally absorb a percentage of any losses. He was consistently fair and accommodating to the needs and risk tolerance of the different partners. Those willing to take more risk were charged a lower fee. When he took on additional risk, he charged more. 1 BPL. While he started with $105,100 and a single partnership, by 1960 assets had grown to $1,900,000 across 7 distinct partnerships, and it was getting a bit unwieldy. He indicated his desire to merge the partnerships for the first time, acknowledging the issue of varying performance across partnerships. The family is growing. There has been no partnership which has had a consistently superior or inferior record compared to our group average, but there has been some variance each year despite my efforts to keep all partnerships invested in the same securities and in about the same proportions. This variation, of course, could be eliminated by combining the present partnerships into one large partnership. Such a move would also eliminate much detail and a moderate amount of expense. Frankly, I am hopeful of doing something along this line in the next few years. The problem is that various partners have expressed preferences for varying partnership arrangements. Nothing will be done without unanimous consent of partners. The consolidation to one entity in 1962, Buffett Partnership Limited, BPL, removed any potential for further performance variation among partners. The move was well timed because his total partnership assets had more than tripled in a single year to $7,178,500. Buffett's personal share accounted for 14.3%, and when the collective interest of his family members was added, the Buffett family accounted for slightly more than 25%. This is a remarkably high percentage, more akin to a family office than a hedge fund or partnership. Buffett was now not just the general partner collecting fees. He and his family also had more at stake financially than any other limited partner. BPL's terms. When all partnerships were consolidated into BPL, all LPs were asked to migrate to the same universal terms. The interest provision was set at 6% for everyone, beyond which Buffett would take 25% of the gains. Since he figured the market was going up 5 to 7% a year on average, the interest provision was set at a level so he earned nothing unless he was beating the market. He had a high water mark. Any cumulative deficiency below a 6% annual gain would have to be recouped before he would resume taking his fee. Some partners relied on the partnership for income and wanted to collect on their interest provision. Others wanted the maximum amount of capital to remain invested. In order to appease both groups, the 6% would be distributed 0.5% each month to those who wanted it. Those who wished to keep their funds fully invested could choose to forego these payments, which would be reinvested back into the partnership at year-end. Let's now look at the ways Buffett's structure for the partnership was a brilliant example of how to align manager incentives and investor objectives. The ability to design simple, easy-to-understand incentive structures has remained a key source of Buffett's success throughout the partnership years, and indeed throughout his entire career. Ways managers get paid when investors don't. Today's hedge funds and mutual funds typically charge a management fee, computed as a fixed percentage of the investor's assets under management. These can range from 0.25% to 2% or more per year, and the fee is taken irrespective of performance. Because the asset management business is highly scalable, an increase in assets usually requires few additional costs. The more funds under management, the more profitable the asset manager will be. While performance is certainly a key component of a fund's ability to grow, a great marketing effort can bring in new investors and has the ability to drive asset growth even faster. Most asset managers, particularly mutual fund companies, earn fees and therefore are incentivized to maximize the size of their total assets. Fees based on a fixed percent of assets under management make it hard for asset managers to say no to the incremental dollar of investor capital, even when it's clearly going to have a dampening effect on performance. When an investor's primary interest, annual percentage gains, is out of step with the primary interest of the manager, more assets, more fees, a potential conflict exists. Buffett charged no management fee. He got paid only on performance. His system was better because it removed a source of potential conflict between his interest and the interest of the LPs. Underperformance fee. In addition to not charging a management fee, Buffett thought he should get paid only for performance in excess of what a do-nothing investor would otherwise get. He only took a fee beyond a 6% return threshold, which was the midpoint of his 5 to 7% average return expectation for the market. In this way, he was further aligned with his partner's interests. Today, hedge funds tend to charge what's known as 2 and 20. The 2% is the management fee, and then they charge an additional 20% of all profits without a threshold minimum return. Managers can earn big fees even if they deliver nominally positive returns while failing to outperform the market. This has been the unpleasant state of affairs since the end of the financial crisis, where the hedge fund industry, in aggregate, has failed to outperform the broad market index each and every year, 2008 to 2014. Like Buffett's duck analogy, these funds have failed to flap their wings, but the investors in these products have still been asked to pay 20% of their gains in fees. Buffett's pay-for-performance structure lives up to his own ideas about treating people the way he would want to be treated if their positions were reversed. Heads they win, tails we lose. In many cases, fund managers' personal stakes are not a significant portion of the assets being managed or their personal net worth. This can result in a heads they win, tails we lose dynamic where the manager who does well gets paid spectacularly, but when they do very poorly, we also do poorly, but they simply close their fund. A manager who has a down 30% year but doesn't have a significant portion of his or her net worth in the fund will certainly miss out on a performance fee, but will take a smaller loss themselves relative to their investors. If the fund were to close, the investors not only lose 30% of their capital, they lose the value of the high water mark, which gives them the ability to recoup their losses before they start paying performance fees again. Buffett and his family were the largest partners of BPL. With the most capital at stake, he was aligned with all partners' interests in maximizing performance. He had to focus on risk to protect his own capital and reward both to grow the capital he had in the partnership and to generate fees. Buffett was like many of today's hedge funds in that he was certain to do splendidly well if his results were great, but where he was unique was that he also set it up so that if the partnership's results were poor, his performance would be equally miserable. Liquidity provisions. Buffett set it up so that additions and redemptions could be made only once a year, which forced investors to look at their performance from a long-term perspective. However, partners could borrow as much as 20% of their capital or pre-fund year-end additions. For this privilege, Buffett charged or paid 6% interest respectively, giving LPs access to funds in the event that they really needed them, and more than fairly compensating those who wished to add to their existing investment. Here, Buffett explained his un-Buffett-like 6% borrowing lending feature. Why then the willingness to pay 6% for advance payment money when we can borrow from commercial banks at substantially lower rates? For example, in the first half we obtained a substantial 6-month bank loan at 4%. The answer is that we expect on a long-term basis to earn better than 6%. The general partner's allocation is 0 unless we do, although it is largely a matter of chance whether we achieve the 6% figure in any short period. Moreover, I can adopt a different attitude in the investment of money that can be expected to soon be a part of our equity capital than I can on short-term borrowed money. The advance payments have the added advantage to us of spreading the investment of new money over the year, rather than having it hit us all at once in January. On the other hand, 6% is more than can be obtained in short-term dollar-secure investments by our partners, so I consider it mutually profitable. Through the commentary and description of the partnership structure, Buffett gives investors several important lessons on how an investment manager's incentives can be aligned with investors' objectives. We can look to management fee, the performance fee, see how much skin they have in the game, and what the liquidity provisions are to make our own assessment and choose the manager who is most aligned with our objectives. Moreover, observing the world through the lens of incentives is a valuable tool whenever you're trying to predict any outcome where people are involved. Incentives make the world go round. It's helpful to think it through backward and look for ways that others will do well when you won't, an obvious red flag. If you're considering investing with an active manager today, you can be sure that most salespeople aren't going to highlight these for you. You're going to have to figure them out on your own. Here again we see the power of Munger's incentive superpower and the difficulty with hiring your thinking done. As he said, in most cases it works terribly. However, all you can do is your best, and if you're going to hire an outside manager, a comparison to Buffett's partnership structure and the incentive biases it was structured to avoid is a good place to start. From the Partnership Letters. Full 1960 letter on BPL's structure. July 22, 1961. To my partners. In the past, partners have commented that a once-a-year letter was a long time between drinks, and that a semi-annual letter would be a good idea. It really shouldn't be too difficult to find something to say twice a year, at least it isn't this year. Hence, this letter which will be continued in future years. During the first half of 1961, the overall gain of the Dow Jones Industrial Average was about 13%, including dividends. Although this is the type of period when we should have the most difficulty in exceeding this standard, all partnerships that operated throughout the 6 months did moderately better than the average. Partnerships formed during 1961 either equaled or exceeded results of the average from the time of formation, depending primarily on how long they were in operation. Let me, however, emphasize 2 points. First, 1 year is far too short a period to form any kind of an opinion as to investment performance, and measurements based upon 6 months become even more unreliable. One factor that has caused some reluctance on my part to write semi-annual letters is the fear that partners may begin to think in terms of short-term performance, which can be most misleading. My own thinking is much more geared to 5-year performance, preferably with tests of relative results in both strong and weak markets. The second point I want everyone to understand is that if we continue in a market which advances at the pace of the first half of 1961, not only do I doubt that we will continue to exceed the results of the DJIA, but it is very likely that our performance will fall behind the average. Our holdings, which I always believe to be on the conservative side compared to general portfolios, tend to grow more conservative as the general market level rises. At all times, I attempt to have a portion of our portfolio in securities at least partially insulated from the behavior of the market, and this portion should increase as the market rises. However appetizing results for even the amateur cook, and perhaps particularly the amateur, we find that more of our portfolio is not on the stove. We have also begun open market acquisition of a potentially major commitment, which I, of course, hope does nothing market-wise for at least a year. Such a commitment may be a deterrent to short-range performance, but it gives strong promise of superior results over a several-year period, combined with substantial defensive characteristics. Progress has been made toward combining all partners at year-end. I have talked with all partners joining during this past year or so about this goal, and have also gone over the plans with representative partners of all earlier partnerships. Some of the provisions will be A. A merger of all partnerships based on market value at year-end, with provisions for proper allocation among partners of future tax liability due to unrealized gains at year-end. The merger itself will be tax-free and will result in no acceleration of realization of profits. B. A division of profits between the limited partners and general partner, with the first 6% per year to partners based upon beginning capital at market, and any excess divided 1/4 to the general partner and 3/4 to all partners proportional to their capital. Any deficiencies in earnings below the 6% would be carried forward against future earnings, but would not be carried back. Presently, there are 3 profit arrangements which have been optional to incoming partners: interest provision, excess to general partner, excess to limited partners. A table showing these arrangements can be found on the enhancement. C. In the event of profits, the new division will obviously have to be better for limited partners than the first 2 arrangements. Regarding the third, the new arrangement will be superior up to 18% per year, but above this rate, the limited partners would do better under the present agreement. About 80% of total partnership assets have selected the first 2 arrangements, and I am hopeful, should we average better than 18% yearly, partners presently under the third arrangement will not feel short-changed under the new agreement. D. In the event of losses, there will be no carryback against amounts previously credited to me as general partner, although there will be a carry forward against future excess earnings. However, my wife and I will have the largest single investment in the new partnership, probably about 1/6 of total partnership assets, and thereby a greater dollar stake in losses than any other partner or family group. I am inserting a provision in the partnership agreement which will prohibit the purchase by me or my family of any marketable securities. In other words, the new partnership will represent my entire investment operation in marketable securities, so that my results will have to be directly proportional to yours, subject to the advantage I obtain if we do better than 6%. E. A provision for monthly payments at the rate of 6% yearly, based on beginning of the year capital valued at market. Partners not wishing to withdraw money currently can have this credited back to them automatically as an advance payment, drawing 6%, to purchase an additional equity interest in the partnership at year-end. This will solve one stumbling block that has heretofore existed in the path of consolidation, since many partners desire regular withdrawals and others wish to plow everything back. F. The right to borrow during the year up to 20% of the value of your partnership interest at 6%, such loans to be liquidated at year-end or earlier. This will add a degree of liquidity to an investment which can now only be disposed of at year-end. It is not intended that anything but relatively permanent funds be invested in the partnership, and we have no desire to turn it into a bank. Rather, I expect this to be a relatively unused provision, which is available when something unexpected turns up, and a wait until year-end to liquidate part or all of a partner's interest would cause hardship. G. An arrangement whereby any relatively small tax adjustment made in later years on the partnership's return will be assessed directly to me. This way, we will not be faced with the problem of asking 80 people or more to amend their earlier return over some small matter. As it stands now, a small change, such as a decision that a dividend received by the partnership has 63% a return of capital instead of 68%, could cause a multitude of paperwork. To prevent this, any change amounting to less than $1,000 of tax will be charged directly to me. We have submitted the proposed agreement to Washington for a ruling that the merger would be tax-free and that the partnership would be treated as a partnership under the tax laws. While all of this is a lot of work, It will make things enormously easier in the future. You might save this letter as a reference to read in conjunction with the agreement which you will receive later in the year. The minimum investment for new partners is currently $25,000, but of course, this does not apply to present partners. Our method of operation will enable the partners to add or withdraw amounts of any size, in round $100, at year-end. Estimated total assets of the partnership will be in the neighborhood of $4 million, which enables us to consider investments such as the one mentioned earlier in this letter, which we would have had to pass several years ago. This has turned out to be more of a production than my annual letter. If you have any questions, particularly regarding anything that isn't clear in my discussion of the new partnership agreement, be sure to let me know. If there are a large number of questions, I will write a supplemental letter to all partners, giving the questions that arise and the answers to them. Compounded wisdom. Once you start viewing the world through the lens of incentives, many otherwise challenging decisions become easier to make. When we know what motivates people, we pretty much know how they will behave. The lessons from the partnership structure therefore go well beyond how to avoid making mistakes in choosing your next investment manager, although they also help with that decision. Where we really see incentives at work is when we start to evaluate businesses, and particularly business managers. As business owners, shareholders, we want to understand the motivational drivers of those in charge of our assets. Here we're talking about securities analysis and stock picking. Our next section looks at the three principal types of stock picking Buffett did for the partnership. He referred to these three categories as generals, workouts, and controls. Part 2. Chapter 6. The Generals. We like good management. We like a decent industry. We like a certain amount of ferment in a previously dormant management or stockholder group, but we demand value. January 18, 1964. How do you define your investment style? Are you drawn to deep value situations? Do you like to hunt for the cheapest of the cheap, irrespective of the underlying business's quality or current fundamentals, with the view that you'll be protected by an attractive purchase price that harnesses the power of mean reversion in your favor? This was one of Graham's principal approaches and continues to define how many great investors operate today. Or perhaps you prefer to look for great, high-return, well-protected franchise businesses that can compound at above-average rates for long periods of time, companies in situations where competition is somehow being kept at bay. Another huge swath of modern value investors spend their time primarily in this field, looking for great companies at reasonable prices. Maybe you're at your investing best when scouring the universe of micro-cap companies where institutional investors can't go, or, then again, maybe you tend to find the most value in well-followed mid- and large-cap companies trading in plain sight. You might like to find the undiscovered opportunities yourself. Or maybe you're more prone to wait for well-respected, well-informed investors to do the work first, then coattail their ideas. You might even be interested in influencing corporate management teams yourself by amassing a significant portion of a company's outstanding shares. With microcap companies, some individuals will have this additional option open to them. Which of these can we say was Buffett's style in the partnership years when he was working with relatively modest capital? The answer is he was all of the above. You can be too. There is absolutely no need to classify yourself into a particular style bucket. You will, however, need to figure out what is and isn't going to work for you. You may be capable or inclined to operate in some of the above fields and not in others. There are no right answers. No one approach is necessarily better than another, although some might be better for you than others. Once you understand yourself, you can simply go where the opportunities are. By tracing the arc and diversity of Buffett's investing styles and understanding why he migrated his focus from Graham's deep value focus to a larger interest in quality, We can take and use the methods that will work best for us in our own investment endeavors. We start with the generals, or generally undervalued securities, because these were, and remain, the bread-and-butter general equity investments that have always defined value investing. For Buffett, the generals were a highly secretive, highly concentrated portfolio of undervalued common stocks that produced the majority of the partnership's overall gains. Buffett was the ultimate craftsman in the art of stock picking, and this was the primary field in which he plied his trade. No general was ever named explicitly, with one exception, Commonwealth Trust Company, which Buffett disclosed only after the investment operation was complete and the stock was no longer a holding of the partnership. He disclosed it in order to illustrate the type of stocks he was buying in this category. Individual investments were otherwise considered trade secrets. Using the Moody's manuals and other primary sources of statistical data, Buffett scoured the field to find stocks trading at rock-bottom valuations. Often these were tiny, obscure, and off-the-radar companies trading below their liquidation value. In the early years especially, the partnership was small enough to be largely unconstrained, allowing for a go-anywhere, do-anything approach similar to that of most individual investors today. As the partnership grew, smaller companies became increasingly less investable. When BPL got too big, even if they could have acquired a significant amount of these companies' outstanding shares, the investment dollars at stake would just be too small to move the needle on the partnership's overall results. Regardless of size, all investors can follow Buffett's lead and load up when we find a really good idea that meets our requirements. Throughout the partnership years, Buffett typically committed 5 to 10% of his total assets in 5 or 6 generals, with smaller positions in another 10 to 15%. Concentrating on the best ideas was a key component of his success. We see him take this concept even further in 1965, when he amended the ground rules to allow as much as 40% of the portfolio in a single general. You'll recall from lessons in Part 1 that the investor's primary focus is on getting the business analysis and the valuation right, not the timing of when they will work out. Many of the generals remained in the portfolio for years. As the partnership grew and additional capital was received, Buffett would add to existing positions that remained attractively priced. Buffett trusted his method to the point that he wasn't affected by the day-to-day vagaries of the market. He believed that sooner or later the market would reward his analysis and valuation efforts. With a portfolio of value stocks, investors should expect that some will be working, rising in price faster than the overall market, while others will be lying fallow or even declining. Irving Kahn, a Buffett contemporary and former teaching assistant to Graham, had the best analogy for this. He taught that an investment portfolio is like an orchard of fruit trees. You cannot expect fruit every year from each species of tree. Each will ripen according to its own, typically unknowable schedule. In aggregate, though, a portfolio of properly selected generals should do better than the market over time. For the partnership, Buffett expected his would do about 10% better. Sometimes these work out very fast. Many times they take years. It is difficult at the time of purchase to know any specific reason why they should appreciate in price. However, because of this lack of glamour or anything pending which might create immediate favorable market action, they are available at very cheap prices. A lot of value can be obtained for the price paid. This substantial excess of value creates a comfortable margin of safety in each transaction. This individual margin of safety, coupled with a diversity of commitments, creates a most attractive package of safety and appreciation potential. Over the years, our timing of purchases has been considerably better than our timing of sales. We do not go into these generals with the idea of getting the last nickel, but are usually quite content selling out at some intermediate level between our purchase price and what we regard as fair value to a private owner. Many of the generals were acquired at steep discounts to their appraised intrinsic value using the private owner method, what a well-informed private buyer would pay for the entire company. These tended to be much smaller companies where, if the stock remained dormant in price for long enough, Buffett would come to gain a large enough stake to have a say over how it was being run. He was, in effect, willing to become the well-informed private buyer himself. Through this process, several companies that started out as generals became controlled investments of the partnership, and thus a wholly separate category of investments that we'll explore later in this section. Occasionally, other private owners, third parties, not Buffett, would buy the partnership out of its stake in a general to obtain control for themselves. This made the private owner method a less risky investment method because the stocks would either appreciate on their own, or Buffett or some other third party would acquire enough stock to at least influence and sometimes take full control of the companies. This typically led companies to take the necessary steps to realize the value inherent in their business. As long as he was right in his analysis and the value was really there, the chance of a permanent loss in these types of investments was minimal. Later, Buffett expanded beyond this private owner method for selecting generals and began acquiring the stocks of companies that he deemed too large for a single private owner to acquire, but that were still undervalued relative to where peer companies were trading. To distinguish this group, he subdivided generals. The generals we've been discussing up to this point were now called generals private owner, and the new category was called generals relatively undervalued. This new investment method was somewhat riskier because there was no potential for the Buffett partnership or any other private owner to acquire control in these companies. Buffett mitigated some of that risk by hedging them, meaning when he bought one, he would sell short the more expensive peer company. For example, by buying a stock trading at 10 times earnings and simultaneously shorting a similar company trading at 20 times earnings, Buffett reduced the risk of overpaying for the company he liked because, if it declined to, say, 8 times, one would expect the stock of the company he sold short at 20 times to decline further. Both categories of generals are more sensitive to the market cycle than workouts and controls. As Buffett put it, just because something is cheap does not mean it is not going to go down. During abrupt downward movements in the market, this segment may very well go down percentage-wise just as much as the Dow. Over a period of years, I believe the generals will outperform the Dow, and during sharply advancing years, this is the section of our portfolio that turns in the best results. It is, of course, also the most vulnerable in a declining market. Because the market trends higher over time, this isn't much of a drawback longer term, but it can impact performance figures from year to year. If the partnership had only invested in generals, its year-to-year record would not have been nearly as stable as it was. The essential methods involved in investing in generals come down to doing good valuation work and doing it consistently. Intrinsic value can be estimated a number of different ways. Most are a derivation of an appraisal of either the value of a company's 1. Assets or 2. Earnings power. Each method, asset-based or earnings-based, can be useful at different times, and indeed they are linked. The value of any asset will always be linked to the earnings it is capable of producing. However, one approach is typically more practical depending on the situation. The current level of profit in relation to the assets of any business can help steer you to the appropriate choice. Often, both an earnings and an asset-based approach can be used to cross-check one against the other. The letters provide examples of Buffett using both. In some situations, Buffett was buying companies that were not very profitable but owned valuable assets. When a company is doing a poor job generating sufficient earnings in relation to the value of its assets, a liquidation value approach, which estimates the realizable resale or auction value of the assets, can be the best choice. Graham is best known for this approach. He got excited when he came upon the ultra-cheap companies that had liquid current assets. Here we're talking about cash in the bank, unsold inventories or receivables, that in aggregate, even after subtracting all the liabilities of the business, were worth more than the market value of the company. We see Buffett using this approach as well, especially in the early years. In other cases where companies had earnings that were healthy, we see Buffett using an earnings-based valuation. This can be the way to go when the business is expected to continue largely as is. It is a simple estimation of the present value of all future expected earnings. As mentioned, Commonwealth Trust of Union City, New Jersey was the first and only general described in the letters, and offers a glimpse into his methods. Buffett evaluated the company's value based on an earnings approach. Commonwealth had earnings of about $10 per share, which he saw as resilient and growing. As he described it, he figured the intrinsic value of such an earnings stream was $125 per share, and he expected that value to build over time. It should be no surprise, then, that when the stock became available at $50, he put 10 to 20% of the various 1957 partnerships into the stock. In 1958, he sold at $80 in order to move on to another stock he liked even more. You can gain great insights about investing from a careful study of Buffett's generals. He was constantly appraising the value of as many stocks as he could find, looking for the ones where he felt he had a reasonable ability to understand the business and come up with an estimate for its worth. With a prodigious memory and many years of intense study, he built up an expansive memory bank full of these appraisals and opinions on a huge number of companies. Then, when Mr. Market offered one at a sufficiently attractive discount to its appraised value, he bought it. He often concentrated heavily in a handful of the most attractive ones. Good valuation work and proper temperament have always been the two key pillars of his success as an investor. Buffett was a highly disciplined buyer, especially in the early years. In many cases, a stock that he was involved in appreciated before he could buy the full amount he wanted. He took several opportunities to lament those lost opportunities, noting that while partners may have been satisfied with the near-term performance figures these stub positions produced, he recognized that had those stocks not appreciated so quickly, he would have been able to acquire more, and the ultimate results for the partnership would have been better. This happened in 1966. While any gains looked particularly good in the market environment that intimately developed in 1966, you can be sure I don't delight in going round making molehills out of mountains. The molehill, of course, was reflected in 1966 results. However, we would have been much better off from a long-range standpoint if 1966 results had been 5 percentage points worse and we were continuing to buy substantial quantities of the stock at the depressed prices that might have been expected to prevail in this year's market environment. Why Generals Work. On May 17, 1984, the 50th anniversary of the first publication of Securities Analysis, Buffett laid out why value investing works in one of his seminal speeches titled The Super Investors of Graham and Doddsville. The super investors he identified were a relatively small group of Graham's students and disciples, himself and Charlie Munger included, who all had a long history of investing in generals. To Buffett, the collective superior performance of this cohort proved the validity of the value investing method and demonstrated a great flaw in the efficient market hypothesis. Buffett encouraged listeners to think of how unlikely it would be that 10 finalists in a hypothetical national coin-flipping contest would all hail from the same town. If investing success was all luck and randomness, as the efficient market theory suggested, just like coin-flipping, how could the country's best all originate from the same town, Graham and Doddsville, USA, where everyone was using the same methods? The super investors of Graham and Doddsville's tremendous results represented a statistical absurdity under the efficient market framework, which would have predicted that the successful investors were randomly distributed throughout the country. After introducing the stellar records of this anomalous group, Buffett laid out their unifying method, which should sound familiar. While they differ greatly in style, these investors are mentally always buying the business, not buying the stock. Emphasis Buffett. Their attitude, whether buying all or a tiny piece of a business, is the same. Some of them hold portfolios with dozens of stocks, others concentrate on a handful, but all exploit the difference between the market price of a business and its intrinsic value. Value investors' methods are highly atypical in one important way. Usually, when a new idea or rules-based trading system is introduced and shown to be effective, market participants copy it, and by doing so, the excess return from the new idea gets arbitraged away. Simply buying cheap stocks, however, has remained a remarkably effective strategy, despite the fact that its efficacy has been well documented for decades. Buffett concludes his famous speech by addressing this anomaly. I can only tell you that the secret has been out for 50 years, ever since Ben Graham and David Dodd wrote Security Analysis. Yet I have seen no trend toward value investing in the last 35 years I've practiced it. There seems to be some perverse human characteristic that likes to make easy things difficult. The academic world, if anything, has actually backed away from the teaching of value investing over the last 30 years. It is likely to continue that way. Ships will sail around the world, but the Flat Earth Society will continue to flourish. There will continue to be wide discrepancies between price and value in the marketplace, and those who read their Graham and Dodd will continue to prosper. And the crowd goes wild. The full text of the speech is available on Columbia's website. The Deep Value Method. Graham, in a 1946 Graham Newman's investor letter that Buffett surely read, spoke about how his investment company largely focused on the purchase of securities at prices less than their intrinsic value as determined by careful analysis, with particular emphasis on purchase of securities at less than their liquidating value. The origin of this approach was grounded in the history of its creator. Buffett's mentor had been wiped out in the stock market crash of 1929. Benjamin Graham's own mother was devastated by the crash before it. There is little surprise Graham focused on tangible net asset and liquidation values in order to ensure that a significant backstop of value existed to limit the risk of a permanent loss in an investment. Because his primary focus was not to lose money, Graham liked to look down before he looked up. He relished acquiring companies that could, if necessary, be shuttered, where all the assets could be sold off and all the debts and obligations extinguished, and yet still, once all this activity was complete, a residual amount would be remaining as a profit above the market price. These companies were literally worth more dead, in liquidation, than they were alive, as going concerns. It's not that the companies were actually liquidated all that often, although sometimes they were. The point was that there was value in the equity even in liquidation. Graham's system not only generated healthy returns, but also all but ensured that he would never go broke again. Buffett was also purchasing these kinds of stocks for the partnership, called net-nets for short. In these situations, he often found some combination of a large pile of cash, securities in the bank, trade receivables due, or saleable inventory. The collective liquidation value of these assets alone was netted against all the company's liabilities. When what remained was still worth more than the market price of the company, he possessed a large margin of safety. Buyers like Graham and Buffett, and the once famous Ned "Netquick" Evans, whose name in his era was as well known as Buffett's is today, defined the times by investing in these types of situations. Whether they chose to wind up the business at a profit or allowed it to recover on its own, they were usually buying below the liquidation value, getting the value of the underlying business for free or even at a negative value. Think about that. Take a simplified example of a company with a market value of $45 that has no debt and cash and securities in the bank worth $65. The only way that market price can make sense is if the company's underlying business is expected to produce either a large amount or a long stream of losses in the future. How else could a business have a negative present value of $20? Should the business simply liquidate, the buyer at $45 stands to receive the full $65 value of the cash and securities, realizing a 45% gain, $20, before factoring in the other assets and the cost of winding it up. Of course, if the business operates at a loss that is expected to continue indefinitely, it will eventually erode away any surpluses that may be present. In such cases, something has to be done to preserve the value, either through the action of a motivated management or through actions taken by the shareholders. After all, shareholders, the owners of the business, have the ultimate say. They elect the board of directors, who in turn hire the management and set the strategy. As Buffett describes it, generals that also offered the potential for a majority stake represented a two strings to our bow situation, where we should either achieve appreciation of market prices from external factors or from the acquisition of a controlling position in a business at a bargain price. While the former happens in the overwhelming majority of cases, the latter represents an insurance policy most investment operations don't have. In other words, Buffett was willing to take the action needed to realize the value in his net-nets if necessary. In the 1980s, this approach was called corporate raiding, but is now more politely referred to as activism. Buffett was willing to take on management if that's what was necessary to create value. Better yet was when he spotted others doing the work on behalf of all shareholders, and he could go along for the ride. Investing alongside them, but not participating in the activism directly, was called coattail riding. Anyone can do that. Buying the securities right after an activist files a 13D, a formal Securities and Exchange Commission document signaling an investor's intent to attempt influence over corporate decisions, is a strategy that has meaningfully outperformed the market over time. Today, Graham-inspired ultra-cheap generals tend to emerge in smaller, obscure securities. They frequently trade off the major exchanges, and their prices are often published only periodically, as opposed to the mainstream issues that are listed in the newspapers daily. Often these companies are not covered by Wall Street research houses. Buffett and his contemporaries had to hunt for them, and they loved the hunt. This is fertile ground for small, enterprising investors. First, familiarize yourself with all the net-nets in the market. While Buffett thumbed through the Moody's manual page by page, there are plenty of free stock screeners on the web these days to help you get started. Then, as you go along, cross the ones off the list when you find a disqualifier, such as a hidden liability or a lawsuit that causes the stock to screen as a net-net even when it isn't. One warning: it's very unlikely that anyone is going to bring these investment opportunities to you. You have to find them yourself. Be particularly skeptical of stock promoters in this area of the market. If you find yourself being pitched a stock of this sort, first grab your wallet, then run. One current example of a net-net is Namtai Property Incorporated, a closely held, small-cap U.S.-listed company, symbol NTP, that has shifted its business from the manufacturing of electronic components to the development of property in China. The total market value of the company is currently around $219 million, or $5.52 for each of the 39.62 million shares outstanding. With $250 million, or $6.15 per share of net cash in the bank, an investor today can purchase Namtai's dollar bills in the bank for 90 cents apiece, and also get all the other assets of the company, mostly properties in China that I believe have substantial value, for free. Namtai's ultra-cheap price is largely an anomaly, but can be partially understood by several key facts. First, it's a very small company. With a total market cap of less than $250 million, most professional investors will deem it too small to do the work on. Second, it's in the process of shifting its business model from manufacturing to property development, and so it's hard to say with any precision what level of earnings they will be capable of producing in the future. Third, there are no Wall Street analysts currently publishing research on the company. Lastly, their operations are all in China, and China is currently out of favor. The new idea. Grahamite super investors were all originally taught to jump from cheap stock to cheap stock. The results were typically fabulous and the chance of loss was small. Again, most of these are not good businesses, but they are often mouthwateringly cheap, and good returns for buyers of a portfolio of these securities are almost a lock given the prices paid. Buffett, looking back 12 years into the partnership, said, Over the years, this has been our best category, measured by average return, and has also maintained by far the best percentage of profitable transactions. This approach was the way I was taught the business, and it formerly accounted for a large proportion of all our investment ideas. Our total individual profits in this category during the 12-year BPL history are probably 50 times or more our total losses. Buffett has since called the whole category of net-nets and other ultra-cheap stocks his soggy cigar butts. To this day, he describes these often marginally profitable companies as mostly gross and disgusting from a business standpoint, but for a time he did very well investing in them because they offered a free puff, profit, with little risk of permanent loss. Today, a partial interest in a situation like Namtai Property, even at $220 million for the whole company, would be of little interest to Buffett, who's looking for multi-billion-dollar investments. Namtai simply can't move the needle for him, even if he could buy the whole company at the current price. Throughout the partnership, as his assets grew and his thinking evolved, Buffett continued to move toward a broader range in defining what value really meant, and became increasingly willing to broaden the scope of what he would accept in the form of downside protection. He began looking more at the quality of the business to determine how sustainable, and therefore valuable, its earnings might be, moving progressively further away from the statistically cheap hard asset valuation approach used for the cigar butt net-nets. For partners, Buffett provided his most explicit recognition of this evolutionary transition in his fall letter of 1967. As he said then, "The evaluation of securities and businesses for investment purposes has always involved a mixture of qualitative and quantitative factors. At the one extreme, the analyst exclusively oriented to qualitative factors would say, buy the right company with the right prospects, inherent industry conditions, management, etc., and the price will take care of itself. On the other hand, the quantitative spokesman would say, buy at the right price and the company and stock will take care of itself. As is so often the pleasant result in the securities world, money can be made with either approach. And of course any analyst combines the two to some extent. His classification in either school would depend on the relative weight he assigns to the various factors and not to his consideration of one group of factors to the exclusion of the other group. Interestingly enough, although I consider myself to be primarily in the quantitative school, and as I write this no one has come back from recess, I may be the only one left in the class, the really sensational ideas I have had over the years have been heavily weighted toward the qualitative side, where I have had a high probability insight. This is what causes the cash register to really sing. However, it is an infrequent occurrence as insights usually are, and of course no insight is required on the quantitative side. The figures should hit you over the head with a baseball bat. So the really big money tends to be made by investors who are right on qualitative decisions, but, at least in my opinion, the more sure money tends to be made on the obvious quantitative decisions. As you read his comments, remember that while the net-nets and ultra-cheap stocks had largely vanished by 1967, and while he felt that when it came to his quantitative approach to investing he may be the only one left in class, this was only a temporary phenomenon. Quantifiable opportunities are often available, particularly at market cycle lows, and while the extreme cases of ultra-cheap net-nets have become more infrequent from cycle to cycle, value investors of the more quantitative bent, with marginally lower standards of what defines cheap, still manage to do very well with the bargains they find. As he continued in the 1967 letter, October 1967. Such statistical bargains have tended to disappear over the years. This may be due to the constant combing and recombing of investments that has occurred during the past 20 years, without an economic convulsion such as that of the 30s to create a negative bias toward equities and spawn hundreds of new bargain securities. It may be due to the new growing social acceptance and therefore usage, or maybe it's vice versa, I'll let the behaviorists figure it out, of takeover bids which have a natural tendency to focus on bargain issues. It may be due to the exploding ranks of security analysts bringing forth an intensified scrutiny of issues far beyond what existed some years ago. Whatever the cause, the result has been the virtual disappearance of the bargain issue as determined quantitatively, and thereby of our bread and butter. There still may be a few from time to time. There will also be the occasional security where I am really competent to make an important qualitative judgment. This will offer our best chance for large profits. Such instances will, however, be rare. Much of our good performance during the past 3 years has been due to a single idea of this sort. Here we can see two distinct factors operating simultaneously. First, as the bull market was maturing, it was getting harder and harder to find cheap stocks, a phenomenon that is typical of every cycle. But second, and more interesting because it was independent of the market cycle, is Buffett's growing appreciation for the qualities that make a business good as opposed to just cheap. When he said that much of our good performance during the past 3 years has been due to a single idea of this sort, he was talking about the huge position he had taken in American Express, a high-quality franchise business that was not statistically cheap in the Graham sense, but had a tremendous amount of future earnings power. It was a franchise business. As he continued to gain assets, he had no choice but to leave the cigar butt strategy behind. He outgrew it financially. Let's fast forward to Buffett's 2014 Berkshire letter, where he looked back on this time in his life and the merits of the early cigar butt strategy. My cigar butt strategy worked very well while I was managing small sums. Indeed, the many dozens of free puffs I obtained in the 1950s made the decade by far the best of my life for both relative and absolute performance. But a major weakness in this approach gradually became apparent. Cigar butt investing was scalable only to a point. With large sums, it would never work well. In addition, though marginal businesses purchased at cheap prices may be attractive as short-term investments, they are the wrong foundation on which to build a large and enduring enterprise. Selecting a marriage partner clearly requires more demanding criteria than does dating. Berkshire, it should be noted, would have been a highly satisfactory date. If we had taken the tender offer presented, BPL's weighted annual return on its Berkshire investment would have been about 40%. The Quality Compounder Method. As you'll recall, Buffett's slow evolution away from statistical bargains, net-nets, and cigar butts toward better businesses caused him to split the category to accommodate some of his new ideas. The new subcategory of generals was called Generals Relatively Undervalued. Here, Buffett was further breaking away from Graham in some additional ways, largely as a result of Munger's influence. As Buffett continued in his look-back letter, "It took Charlie Munger to break my cigar butt habits and set the course for building a business that could combine huge size with satisfactory profits. The blueprint he gave me was simple. Forget what you know about buying fair businesses at wonderful prices. Instead, buy wonderful businesses at fair prices." Munger also chimed in himself in that letter, looking back on their evolved thinking and saying, "Having started out as Grahamites, which by the way worked fine, we gradually got what I would call better insights, and we realized that some company that was selling at 2 or 3 times book value could still be a hell of a bargain because of the momentum implicit in its position, sometimes combined with an unusual managerial skill plainly present in some individual or other or some system or other. And once we'd gotten over the hurdle of recognizing that a thing could be based on quantitative measures that would have horrified Graham, we started thinking about better businesses. Buffett Partnership, for example, owned American Express and Disney when they got pounded down. Buffett introduced this new category to partners in 1964, the same year he bought the large stake in American Express. There was a scandal at one of its subsidiaries that created a potentially large liability and was perceived to threaten the reputation and value of the brand. The stock had gotten pummeled. Once Buffett realized the issues were recoverable and that American Express could survive the scandal with its brand, reputation, and business fundamentals still intact, Buffett loaded up. The beauty of American Express, like many others in the General's relatively undervalued category, was that it produced magnificent profits year in and year out. He could potentially hold it for a very long time, while most General's private owner investments, with their one free puff, required a treadmill of work. American Express would dominate the partnership's portfolio in its last several years. This was the stock that caused Buffett to amend the ground rules so he could invest up to 40% of the fund in the company. The $13 million he invested produced a whopping $20 million in profits, more than any other investment BPL ever produced in a single security. Another major purchase for this new category of Generals was the Walt Disney Company. After he and Munger dissected the business while touring the park on a family vacation, Buffett bought 5% of the company for $4 million in 1965. Buffett figured he had a softer, less tangible, but equally valuable backstop in the value of the video library, which he estimated justified the stock price on its own with the parks and studio thrown in for free. In a way, he was straddling the quality stocks versus cigar butt hard asset. Today, Buffett talks about buying great businesses at a fair price. These were great businesses at a great price. In keeping with his earlier dictate not to reveal the names of individual firms in which the partnership had invested, Buffett never told his partners that they were such substantial owners of either company. What should you do? Let's return to the question we opened this chapter with. Assuming you are an investor operating with modest sums, should you follow an approach more like Graham and early Buffett, which emphasized statistical value, or should you emphasize quality, in line with how Buffett was investing toward the end of the partnership? Should you focus on the surer things and balance sheet-oriented bargains, or is it better to look for the great, enduring, high-quality businesses that have become the hallmark of Berkshire's acquisition strategy more or less since 1967? One can make a strong case for either method, just as many well-respected investors have done. Both can work, but what's right for you will depend on the size of funds you are working with, your personality, your own ability to do good valuation work, and your ability to define objectively the outer edges of your own competence. Tobias Carlyle, with his 2014 book Deep Value, comes out as a good example of a Graham purist. His research shows that the worse a cheap company's fundamentals, the better the stock is likely to do. With his deeply quantitative orientation, Tobias has developed something he calls the acquirer's multiple to identify and systematically make good investment decisions. He seems to have found something that he understands and that works well for him. Note that he literally shuns quality in his approach to finding value. Below-average returns in an industry tend to cause competitors to flee. Managements motivated to restore at least an adequate return on their time and money often change strategy, improve their process, or stop doing the business that is losing money. Buying stocks that are cheap when the companies are struggling gives the investor a chance to be rewarded twice. Once through improved business results, and then again through an improved market valuation in accordance with the better business results. Tobias's picks are available on his website. While he's smart to have found something that works for him, he's even smarter to avoid what doesn't. Of course he'd prefer to buy a great business over a poor business if he could be sure that it could maintain its high returns well into the future. However, he hasn't yet found a way to identify the companies with the factors needed to protect those high returns from competition, at least systematically, so he avoids them. In a free market system, high-return businesses naturally attract competitors seeking to get in on the action. In the absence of barriers to entry, these competitors will keep coming into an industry until all the outsized returns have been leveled. While this dynamic is the engine of our economic system and the reason behind decades of massive productivity gains for American corporations, it's also the reason returns on equity have consistently cycled around 12 to 14%. That was true in the 1950s, and it's true today. Competition tends to drive good returns down with only a few exceptions. Those who choose to find value in highly profitable companies need to find the ones that are going to stay that way. Tom Gaynor, the longtime investment manager for the Markel Corporation, is a wonderful example of a modern investor with a deep-seated quality bias. He's willing to assess the ability for a high-quality company to endure. He looks for high return, established businesses with strong track records of success through past business cycles, run by managers demonstrating equal measures of talent and integrity. He wants companies to reinvest earnings into high incremental return projects when they are available and return the remaining earnings to shareholders when they are not. Finally, he looks for a reasonable purchase price. He's found a way to outperform the indexes for decades with his system. Tom emphasizes that you have to get only a very small number of these right for this type of strategy to really pay off. The companies you get right will harness the power of compounding and grow to dwarf the mistakes. He argues that investors who make 20 or so sound purchases over a lifetime will come to see one or two grow to become a significant percentage of their net worth. Tom has a great example of this phenomenon that also reminds us not to pigeonhole Ben Graham as purely a deep value investor. Graham paid up for quality when he bought the insurance company Geico. He ended up making more profits from that single investment than he did from all his other activities combined. Tom's strategy is almost the opposite of Tobias's, but he understands it, and it works for him. Neither one is right or wrong. Each has developed a value system that works for him. What's right in investing is what works for the individual. Other well-respected modern investors, also unconstrained by the size of their capital base, are able to invest using both categories. Professor Joel Greenblatt, a brilliant investment manager, has put together one of history's best track records by investing in special situations and misunderstood small-cap companies. He now uses a system that quantitatively identifies high-quality stocks trading at attractive valuations that he calls the magic formula, which has also worked exceedingly well. As you can see, there are many ways modern investors are successfully utilizing the various methods used in the partnership years, even the ones Buffett himself has long since moved on from. When they were available to him, he did wonderfully well with the net-nets and cigar butts that Tobias now favors. Some of his highest return years were had when he was investing in the 1950s in the special situations that Greenblatt later did so well with. When his funds grew to a size that made these types of activities too small to move the performance needle, he moved on to investing in the style Tom Gaynor has largely picked up on. All work. The important question is really, what will work for you? Here again, as you can probably guess by now, we are talking about knowing yourself, what Buffett would later call the circle of competence. Remaining in the circle is a linchpin of Buffett's success. He has consistently shown that when he finds something he likes and can understand, whether it be a net-net or a compounder, he has pounced. He passes on anything seen as outside the circle. In a 2007 talk to students, Buffett gave the following advice, which sums up the idea of how you should be investing in generals with your circle of competence in mind. I have 3 mailboxes in my office, in, out, and too hard. I was joking with the MIT students that I should have a too hard bin, and they made me one. So now I have it, and I use it. I will only swing at pitches that I really like. If you do it 10 times in your life, you'll be rich. You should approach investing like you have a punch card with 20 punch-outs, one for each trade in your life. As Buffett continued in his talk to students, I think people would be better off if they only had 10 opportunities to buy stocks throughout their lifetime. You know what would happen? They would make sure that each buy was a good one. They would do lots and lots of research before they made the buy. You don't have to have many 4 times growth opportunities to get rich. You don't need to do too much, but the environment makes you feel like you need to do something all the time. Here is a checklist for evaluating a potential investment in a general. 1. Orient. What tools or special knowledge is required to understand the situation? Do I have them? 2. Analyze. What are the economics inherent to the business and the industry? How do they relate to my long-term expectations for earnings and cash flows? 3. Invert. What are the likely ways I'll be wrong? If I'm wrong, how much can I lose? 4. What is the current intrinsic value of the business? How fast is it growing or shrinking? And finally, 5. Compare. Does the discount to intrinsic value, properly weighted for both the downside risk and upside reward, compare favorably to all the other options available to me? If you find yourself unable to make it all the way through the checklist, then write down in a single paragraph the merits of the investment. If you get caught up along the way, either do more work or simply forget the idea as too hard and move on to something else. While Buffett has made many investments over his long career, only a small handful have accounted for the vast majority of the wealth he's been able to create. Recognizing this, Buffett encourages investors to make a punch card, then only use it when you find yourself inside your own circle of competence. Consider this as you listen to the following case study of Buffett's early general, the Commonwealth Trust Company of Union City, New Jersey, where he put 20% of the early partnership's assets. BPL Case Study, Commonwealth Trust, February 11, 1959. Typical situation. So that you may better understand our method of operation, I think it would be well to review a specific activity of 1958. Last year, I referred to our largest holding, which comprised 10% to 20% of the assets of the various partnerships. I pointed out that it was to our interest to have this stock decline or remain relatively steady, so that we could acquire an even larger position, and that for this reason such a security would probably hold back our comparative performance in a bull market. This stock was the Commonwealth Trust Company of Union City, New Jersey. At the time we started to purchase the stock, it had an intrinsic value $125 per share computed on a conservative basis. However, for good reasons, it paid no cash dividend at all despite earnings of about $10 per share, which was largely responsible for a depressed price of about $50 per share. So, here we had a very well-managed bank with substantial earnings power selling at a large discount from intrinsic value. Management was friendly to us as new stockholders, and risk of any ultimate loss seemed minimal. Commonwealth was 25.5% owned by a larger bank. Commonwealth had assets of about $50 million, about half the size of the First National in Omaha, which had desired a merger for many years. Such a merger was prevented for personal reasons, but there was evidence that this situation would not continue indefinitely. Thus, we had a combination of very strong defensive characteristics, good solid value building up at a satisfactory pace, and evidence to the effect that eventually this value would be unlocked, although it might be 1 year or 10 years. If the latter were true, the value would presumably have been built up to a considerably larger figure, say $250 per share. Over a period of a year or so, we were successful in obtaining about 12% of the bank at a price averaging about $51 per share. Obviously, it was definitely to our advantage to have the stock remain dormant in price. Our block of stock increased in value as its size grew, particularly after we became the second largest stockholder, with sufficient voting power to warrant consultation on any merger proposal. Commonwealth only had about 300 stockholders and probably averaged 2 trades or so per month, so you can understand why I say that the activity of the stock market generally had very little effect on the price movement of some of our holdings. Unfortunately, we did run into some competition on buying, which raised the price to about $65, where we were neither buyer nor seller. Very small buying orders can create price changes of this magnitude in an inactive stock, which explains the importance of not having any leakage regarding our portfolio holdings. Late in the year, we were successful in finding a special situation where we could become the largest holder at an attractive price, so we sold our block of Commonwealth, obtaining $80 per share, although the quoted market was about 20% lower at the time. It is obvious that we could still be sitting with $50 stock patiently buying in dribs and drabs, and I would be quite happy with such a program, although our performance relative to the market last year would have looked poor. The year when a situation such as Commonwealth results in a realized profit is, to a great extent, fortuitous. Thus, our performance for any single year has serious limitations as a basis for estimating long-term results. However, I believe that a program of investing in such undervalued, well-protected securities offers the surest means of long-term profits in securities. I might mention that the buyer of the stock at $80 can expect to do quite well over the years. However, the relative undervaluation at $80 with an intrinsic value $135 is quite different from a price $50 with an intrinsic value of $125. And it seemed to me that our capital could better be employed in the situation which replaced it. This new situation is somewhat larger than Commonwealth and represents about 25% of the assets of the various partnerships. While the degree of undervaluation is no greater than in many other securities we own, or even than some, we are the largest stockholder, and this has substantial advantages many times in determining the length of time required to correct the undervaluation. In this particular holding, we are virtually assured of a performance better than that of the Dow Jones for the period we hold it. The current situation. The higher the level of the market, the fewer the undervalued securities, and I am finding some difficulty in securing an adequate number of attractive investments. I would prefer to increase the percentage of our assets in workouts, but these are very difficult to find on the right terms. To the extent possible, therefore, I am attempting to create my own workouts by acquiring large positions in several undervalued securities. Such a policy should lead to the fulfillment of my earlier forecast, an above-average performance in a bear market. It is on this basis that I hope to be judged. If you have any questions, feel free to ask them. Warren E. Buffett, 21159. From the Partnership Letters, The Generals, January 18, 1964. Generals, a category of generally undervalued stocks, determined primarily by quantitative standards, but with considerable attention also paid to the qualitative factor. There is often little or nothing to indicate immediate market improvement. The issues lack glamour or market sponsorship. Their main qualification is a bargain price, that is, an overall valuation on the enterprise substantially below what careful analysis indicates its value to a private owner to be. Again, let me emphasize that while the quantitative comes first and is essential, the qualitative is important. We like good management. We like a decent industry. We like a certain amount of ferment in a previously dormant management or stockholder group, but we demand value. January 24, 1962. Over the years, this has been our largest category of investment, and more money has been made here than in either of the other categories. We usually have fairly large positions, 5% to 10% of our total assets, in each of 5 or 6 generals, with smaller positions in another 10 or 15. Sometimes these work out very fast. Many times they take years. It is difficult at the time of purchase to know any specific reason why they should appreciate in price. However, because of this lack of glamour or anything pending which might create immediate favorable market action, they are available at very cheap prices. A lot of value can be obtained for the price paid. This substantial excess of value creates a comfortable margin of safety in each transaction. This individual margin of safety, coupled with a diversity of commitments, creates a most attractive package of safety and appreciation potential. Over the years, our timing of purchases has been considerably better than our timing of sales. We do not go into these generals with the idea of getting the last nickel, but are usually quite content selling out at some intermediate level between our purchase price and what we regard as fair value to a private owner. The generals tend to behave market-wise very much in sympathy with the Dow. Just because something is cheap does not mean it is not going to go down. During abrupt downward movements in the market, This segment may very well go down percentage-wise just as much as the Dow. Over a period of years, I believe the generals will outperform the Dow, and during sharply advancing years like 1961, this is the section of our portfolio that turns in the best results. It is, of course, also the most vulnerable in a declining market. January 18, 1963. Many times, generals represent a form of coattail riding, where we feel the dominating stockholder group has plans for the conversion of unprofitable or underutilized assets to a better use. We have done that ourselves in Sanborn and Dempster, but everything else equal, we would rather let others do the work. Obviously, not only do the values have to be ample in a case like this, but we also have to be careful whose coat we are holding. January 18, 1965. Many times in this category we have the desirable two strings to our bow situation, where we should either achieve appreciation of market prices from external factors or from the acquisition of a controlling position in a business at a bargain price. While the former happens in the overwhelming majority of cases, the latter represents an insurance policy most investment operations don't have. We have continued to enlarge the positions in the three companies described in our 1964 mid-year report where we are the largest stockholder. All three companies are increasing their fundamental value at a very satisfactory rate, and we are completely passive in two situations and active only on a very minor scale in the third. It is unlikely that we will ever take a really active part in policy making in any of these three companies, but we stand ready if needed. January 20, 1966. Our largest year-end 1964 investment in this category was disposed of in 1965 pursuant to a tender offer. The fundamental concept underlying the generals, private owner category, is demonstrated by the above case. A private owner was quite willing, and in our opinion quite wise, to pay a price for control of the business which isolated stock buyers were not willing to pay for very small fractions of the business. This has been a quite common condition in the securities markets over many years, and although purchases in this category work out satisfactorily in terms of just general stock market behavior, there is the occasional dramatic profit due to corporate action, such as the one above. January 25, 1967. In the middle of 1965, we started purchasing a very attractive, widely held security which was selling far below its value to a private owner. Our hope was that over a 2 or 3 year period we could get $10 million or more invested at the favorable prices prevailing. The various businesses that the company operated were understandable, and we could check out competitive strengths and weaknesses thoroughly with competitors, distributors, customers, suppliers, ex-employees, etc. Market conditions peculiar to the stock gave us hope that, with patience, we could buy substantial quantities of the stock without disturbing the price. At year-end 1965, we had invested $1,956,980, and the market value of our holding was $2,358,412, so that $401,432 was contributed to performance during 1965. We would have preferred, of course, to have seen the market below cost since our interest was in additional buying, not in selling. This would have dampened Buffett Partnership Limited's 1965 performance and perhaps reduced the euphoria experienced by limited partners. Psychically, the net result to all partners would have been a standoff since the general partner would have been floating, but would have enhanced long-term performance. The fact that the stock had risen somewhat above our cost had already slowed down our buying program and thereby reduced ultimate profit. An even more dramatic example of the conflict between short-term performance and the maximization of long-term results occurred in 1966. Another party, previously completely unknown to me, issued a tender offer which foreclosed opportunities for future advantageous buying. I made the decision that the wisest course, it may not have been, for us to follow was to dispose of our holdings, and we thus realized a total profit of $1,269,181 in February, of which $867,749 was applicable to 1966. While any gains looked particularly good in the market environment that intimately developed in 1966, you can be sure I don't delight in going round making molehills out of mountains. The molehill, of course, was reflected in 1966 results. However, we would have been much better off from a long-range standpoint if 1966 results had been 5 percentage points worse, and we were continuing to buy substantial quantities of the stock at the depressed prices that might have been expected to prevail in this year's market environment. If good ideas were a dime a dozen, such a premature ending would not be unpleasant. There is something to be said, of course, for a business operation where some of the failures produce moderate profits. However, you can see how hard it is to develop replacement ideas by examining our average investment in the private owner category. We came up with nothing during the remainder of the year, despite lower stock prices, which should have been conducive to finding such opportunities. January 22, 1969. Generals, Private Owner. Over the years, this has been our best category, measured by average return, and has also maintained by far the best percentage of profitable transactions. This approach was the way I was taught the business, and it formerly accounted for a large proportion of all our investment ideas. Our total individual profits in this category during the 12-year BPL history are probably 50 times or more our total losses. The cash register really rang on one simple industry idea, implemented in several ways in this area in 1968. We even received a substantial fee, included in other income in the audit, for some work in this field. January 18, 1965. In past annual letters, I have always utilized 3 categories to describe investment operations we conduct. I now feel that a 4-category division is more appropriate. Partially, the addition of a new section, Generals, Relatively Undervalued, reflects my further consideration of essential differences that have always existed to a small extent with our Generals group. Partially, it reflects the growing importance of what once was a very small subcategory, but is now a much more significant part of our total portfolio. This increasing importance has been accompanied by excellent results to date, justifying significant time and effort devoted to finding additional opportunities in this area. Finally, it partially reflects the development and implementation of a new and somewhat unique investment technique designed to improve the expectancy and consistency of operations in this category. January 18, 1965. Generals, Relatively Undervalued. This category consists of securities selling at prices relatively cheap compared to securities of the same general quality. We demand substantial discrepancies from current valuation standards, but, usually because of large size, do not feel value to a private owner to be a meaningful concept. It is important in this category, of course, that apples be compared to apples and not to oranges, and we work hard at achieving that end. In the great majority of cases, we simply do not know enough about the industry or company to come to sensible judgments. In that situation, we pass. As mentioned earlier, this new category has been growing and has produced very satisfactory results. We have recently begun to implement a technique which gives promise of very substantially reducing the risk from an overall change in valuation standards, such as, if we buy something at 12 times earnings when comparable or poorer quality companies sell at 20 times earnings, but then a major revaluation takes place so the latter only sell at 10 times. This risk has always bothered us enormously because of the helpless position in which we could be left compared to the General's Private Owner or Workouts types. With this risk diminished, we think this category has a promising future. January 20th, 1966. Our final category is Generals, Relatively Undervalued. This category has been growing in relative importance as opportunities in the other categories become less frequent. Frankly, operating in this field is somewhat more ethereal than operating in the other three categories, and I'm just not an ethereal sort. Therefore, I feel accomplishments here are less solid and perhaps less meaningful for future projections than in the other categories. Nevertheless, our results in 1965 were quite good in the relatively undervalued group, partly due to implementation of the technique referred to in last year's letter, which serves to reduce risk and potentially augment gains. It should reduce risk in any year, and it definitely augmented the gains in 1965. It is necessary to point out that results in this category were greatly affected for the better by only two investments. January 25, 1967. One final word about the General's relatively undervalued category. In this section, we also had an experience which helped results in 1966 but hurt our long-term prospects. We had just one really important new idea in this category in 1966. Our purchasing started in late spring, but had only come to about $1.6 million. It could be bought steadily, but at only a moderate pace, when outside conditions drove the stock price up to a point where it was not relatively attractive. Though our overall gain was $728,141 on an average holding period of 6.5 months in 1966, it would have been much more desirable had the stock done nothing for a long period of time while we accumulated a really substantial position. Compounded Wisdom. In his commentary on Generals, we see Buffett departing from teaching principles and now teaching methods. While principles never change, they are timeless, methods can and often should change according to a given investing environment. We see different methods used by Buffett at various stages of the partnership, in various stages of the market cycle, in order to best act in accordance with his principles. Through this migration of his style from value to quality, he's providing us with several methods for our own investment endeavors. General's Private Owner and General's Relatively Undervalued are the first two tools he's given us, and they can provide a wide variety of potential choices in the market. We can hunt for bargains, or we can hunt for great businesses. In his discussion of workouts and controls, our next two chapters, we'll continue adding tools to our toolkit and see the ways in which Buffett chooses among them. Chapter 7. Workouts. Give a man a fish and you feed him for a day. Teach him how to arbitrage and you feed him forever. Berkshire Hathaway's 1988 Annual Report. As a boy, Buffett paid 25 cents for 6 packs of Coke at his grandfather's store, then sold the individual cans for a nickel each, making 20% on every 6-pack arbitraged. Buffett had performed a financial trick called arbitrage, a practice that follows a straightforward formula. Something is bought at X, value is added or risk assumed, and then a sale is made at X plus a profit. In a traditional or risk-free arbitrage, profits are made when two identical or near-identical items trade at different prices in different places at a same time. For instance, when a company's stock, identical in every way, trades for a lower price in New York than in London, equity arbitrageurs can buy stock in one city, sell it in the other, and capture the spread. Because this can be done in a nanosecond, electronic trading allows for the shares to be bought in London and sold in New York within a fraction of a second. The operation is generally considered risk-free. Because riskless arb produces free money, opportunities tend to be rare. For example, Buffett executed an early arbitrage at the age of 24 for Graham that was not completely risk-free, but it was low risk. Here is how he's described it. Rockwood & Company, a Brooklyn-based chocolate products company of limited profitability, had adopted LIFO inventory valuation in 1941 when cocoa was selling for 5 cents per pound. In 1954, a temporary shortage of cocoa caused the price to soar to over 60 cents. Consequently, Rockwood wished to unload its valuable inventory, quickly, before the price dropped. But if the cocoa had simply been sold off, the company would have owed close to a 50% tax on the proceeds. The 1954 tax code came to the rescue. It contained an arcane provision that eliminated the tax otherwise due on LIFO profits if inventory was distributed to shareholders as part of a plan reducing the scope of a corporation's business. Rockwood decided to terminate one of its businesses, the sale of cocoa butter, and said 13 million pounds of its cocoa bean inventory was attributable to that activity. Accordingly, the company offered to repurchase its stock in exchange for the cocoa beans it no longer needed, paying 80 pounds of beans for each share. For several weeks, I busily bought shares, sold beans, and made periodic stops at Schroeder Trust to exchange stock certificates for warehouse receipts. The profits were good, and my only expense was subway tokens. In the Rockwood Arb, as long as the various prices didn't move around too much, easy profits could be made. Shares were bought at $34 and exchanged for beans worth $36, which were sold for cash and produced a $2 profit. As long as the price of cocoa held up, the $2 profit was a lock. Each transaction earned a 5.8% return on the capital employed. A $100 applied to the Rockwood Arb could have earned $58 a year if he could get through the whole process 10 times, not compounded. Too bad such low-risk arbitrages don't come along that often. Arbitrageurs usually have to climb another rung of the risk ladder in order to find a sufficient number of opportunities. Merger arbitrage. For BPL, this meant a category of investment Buffett called workouts, more commonly known now as merger arb or risk arb, which involved bets on the likelihood that an announced transaction, usually one company buying another, will actually close. When a company announces its intention to purchase another public company, the selling company's stock typically trades up to a level that's close, but not all the way up to the announced purchase price. The spread between the offer price and the stock price reflects the risk that something will happen to scuttle the deal, as well as the time value of money between now and the expected closing. That's where the arbitrage opportunity lies. Buffett aimed to arbitrage transactions where the spread was sufficiently wide and the probability of the deal actually closing was high. This can be a fantastic business, and it certainly was for Buffett. Like so many of his activities at BPL, he had learned the technique from Graham. Using the record of Graham Newman, BPL, and Berkshire Hathaway in the 65 years through 1988, Buffett figured the average unleveraged return in the arbitrage business was about 20% per year. In the annual report that year, he said, "Give a man a fish and you feed him for a day. Teach a man to arbitrage and you feed him forever." Indeed. We know what 65 years of 20% average annual compounding does. It turns $100 into $14 million. Results tend to be magnified in both directions because borrowed money is typically used alongside the partner's capital in order to obtain larger positions. Buffett's self-imposed limit on the use of borrowed money for arbitrage was 25% of partnership capital, not a trivial sum. The key in this business is not being wrong very often. Because leverage was used, the actual returns for investors were even better. However, to make money in merger arb, the deals have to close. While most go through as planned, some deals get scuttled by unfavorable antitrust law, tax rulings, shareholder disapproval, etc. This is what Buffett called upsetting the apple cart. When this happens, the target stock tends to quickly revert to its pre-buyout price. Buffett described the business when it was profitable as getting the last nickel after the other fellow has made the first 95 cents. Being on the wrong side of a busted arb can be expensive. Not only do you fail to make the nickel, but you can also lose a meaningful chunk of the 95 cents. Buffett probably assessed most deals but was highly selective in the ones he participated in. Workouts is a business that doesn't accommodate very many mistakes. Concentrating investing dollars was a common factor in all of Buffett's operations. While many merger arb businesses tend to spread their investments over many companies simultaneously, BPL typically focused on 10 to 15 at a time, versus a typical arbitrageur who might be in 50 or more. Because he concentrated on a few companies, Buffett's workout mistakes were painfully obvious. Here's what Buffett said in a tough year for workouts. The streets were filled with upset apple carts, our apple carts, during 1967. Thus, on an average investment of $17,246,879, our overall gain was $153,273. For those of you whose slide rule does not go to such insulting depths, this represents a return of 0.89 of 1%. While I don't have complete figures, I doubt that we have been below 10% in any past year. As in other categories, we tend to concentrate our investments in the workout category in just a few situations per year. This technique gives more variation in yearly results than would be the case if we used an across-the-board approach. I believe our approach will result in as great or greater profitability on a long-term basis, but you can't prove it by 1967. Buffett outlined the 4 questions needed to evaluate a workout in his 1988 letter to shareholders of Berkshire. 1. What chance does the deal have of going through? 2. How long will it take to close? 3. How likely is it that someone else will make an even better offer? And 4. What happens if the deal busts? Performance counterweight. Over the long term, workouts were expected to do just as well as the generals, 10 points better than the market, or 15 to 17% per year on average. They not only produced solid, fairly stable returns, but their success was largely independent of the Dow, and so insulated BPL's overall performance in down markets. In most years, they made up 30 to 40% of assets. The allocation served as a useful toggle to Buffett. He told partners in the very first letter to expect BPL to tilt the portfolio mix toward generals when the market was falling, and tilt toward workouts when it was rising. A few years later, controls would join workouts as a market-agnostic business. Buffett referred to this as an accidental factor that sometimes helped performance and sometimes held it back. To give an example of just how important the accident of division between these categories is, let me cite the example of the past 3 years. Using an entirely different method of calculation than that used to measure the performance of BPL in entirety, whereby the average monthly investment at market value by category is utilized, borrowed money and office operating expenses excluded, etc. This gives the most accurate basis for intergroup comparisons, but does not reflect overall BPL results. The generals, both present categories combined, workouts and the Dow, shape up as follows. In 1962, generals minus 1%, workouts 14.6%, Dow minus 8.6%. In 1963, generals 20.5%, workouts 30.6%, Dow 18.4%. In 1964, generals 27.8%, workouts 10.3%, Dow 16.7%. Obviously, the workouts, along with controls, saved the day in 1962, and if we had been light in this category that year, our final result would have been much poorer, although still quite respectable considering market conditions during the year. We could just as well have had a much smaller percentage of our portfolio in workouts that year. Availability decided it, not any notion on my part as to what the market was going to do. Therefore, it is important to realize that in 1962 we were just plain lucky regarding mix of categories. In 1963 we had one sensational workout which greatly influenced results, and generals gave a good account of themselves, resulting in a banner year. If workouts had been normal, say more like 1962, we would have looked much poorer compared to the Dow. Here, it wasn't our mix that did much for us, but rather excellent situations. Finally, in 1964, workouts were a big drag on performance. This would be normal in any event during a big plus year for the Dow, such as 1964, but they were even a greater drag than expected because of mediocre experience. In retrospect, it would have been pleasant to have been entirely in generals, but we don't play the game in retrospect. I hope the preceding table drives home the point that results in a given year are subject to many variables, some regarding which we have little control or insight. We consider all categories to be good businesses, and we are very happy we have several to rely on rather than just one. It makes for more discrimination within each category, and reduces the chance we will be put completely out of operation by the elimination of opportunities in a single category. Let's get arbing. Tread carefully. Buffett's success in this category can make it look simpler than it actually can be. The devil is often in the details of these transactions, and being on the wrong side of a merger arb situation can be costly. Like any of Buffett's 3 categories of investment, proceed only when you're within your circle of competence. You have to understand what you're doing before you do it. Because the unleveraged, unannualized returns are modest, the confidence interval has to be extremely high to do this stuff. Unless the arbitrage opportunity is obvious, these types of transactions are probably best left alone. As you hear the example of the Texas National Petroleum case study, ask yourself how qualified you would have been to assess the likelihood that the eleemosynary status, I had to look it up too, of the University of Southern California was not going to be a problem for the IRS, and that the ABC financing structure would be allowed in this case. BPL Case Study, Texas National Petroleum, 1963 Year-End Letter. January 18, 1964. This situation was a run-of-the-mill workout arising from the #1 source of workouts in recent years, the sellouts of oil and gas-producing companies. TNP was a relatively small producer with which I had been vaguely familiar for years. Early in 1962, I heard rumors regarding a sellout to Union Oil of California. I never act on such information, but in this case it was correct, and substantially more money would have been made if we had gone in at the rumor stage rather than the announced stage. However, that's somebody else's business, not mine. In early April 1962, the general terms of the deal were announced. TNP had 3 classes of securities outstanding. 1. 6.5% debentures callable at 104.25, which would bear interest until the sale transpired, and at that time would be called. There were $6.5 million outstanding, of which we purchased $264,000 principal amount before the sale closed. 2. About 3.7 million shares of common stock, of which the officers and directors owned about 40%. The proxy statement estimated the proceeds from the liquidation would produce $7.42 per share. We purchased 64,035 shares during the 6 months or so between announcement and closing. 3. 650,000 warrants to purchase common stock at $3.50 per share. Using the proxy statement estimate of 7.42 for the workout on the common, resulted in $3.92 as a workout on the warrants. We were able to buy 83,200 warrants, or about 13% of the entire issue in 6 months. The risk of stockholder disapproval was nil. The deal was negotiated by the controlling stockholders, and the price was a good one. Any transaction such as this is subject to title searches, legal opinions, etc., but this risk could also be appraised at virtually nil. There were no antitrust problems. This absence of legal or antitrust problems is not always the case by any means. The only fly in the ointment was the obtaining of the necessary tax ruling. Union Oil was using a standard ABC production payment method of financing. The University of Southern California was the production payment holder, and there was some delay because of their eleemosynary status. This posed a new problem for the Internal Revenue Service, but we understood USC was willing to waive this status, which still left them with a satisfactory profit after they borrowed all the money from a bank. While getting this ironed out created delay, it did not threaten the deal. When we talked with the company on April 23rd and 24th, their estimate was that the closing would take place in August or September. The proxy material was mailed May 9th and stated the sale will be consummated during the summer of 1962, and that within a few months thereafter the greater part of the proceeds will be distributed to stockholders in liquidation. As mentioned earlier, the estimate was $7.42 per share. Bill Scott attended the stockholders' meeting in Houston on May 29th, where it was stated they still expected to close on September 1st. The following are excerpts from some of the telephone conversations we had with company officials in ensuing months. On June 18th, the Secretary stated, "Union has been told a favorable IRS ruling has been formulated, but must be passed on by additional IRS people, still hoping for ruling in July." On July 24th, the President said that he expected the IRS ruling early next week. On August 13th, the Treasurer informed us that the TNP, Union Oil, and USC people were all in Washington attempting to thrash out a ruling. On September 18th, the Treasurer informed us, "No news, although the IRS says the ruling could be ready by next week." The estimate on payout was still $7.42. The ruling was received in late September, and the sale closed October 31st. Our bonds were called November 13th. We converted our warrants to common stock shortly thereafter, and received payments on the common of $3.50 December 14, 1962, $3.90 February 4, 1963, and 15 cents on April 24, 1963. We will probably get another 4 cents in a year or two. On 147,235 shares, after exercise of warrants, even 4 cents per share is meaningful. This illustrates the usual pattern. 1. The deals take longer than originally projected, and 2. The payouts tend to average a little better than estimates. With TNP, it took a couple of extra months, and we received a couple of extra percent. The financial results of TNP were as follows. 1. On the bonds, we invested $260,773 and had an average holding period of slightly under 5 months. We received 6.5% interest on our money and realized a capital gain of $14,446. This works out to an overall rate of return of approximately 20% per annum. 2. On the stock and warrants, we have realized capital gain of $89,304, and we have stubs presently valued at $2,946. From an investment of $146,000 in April, our holdings ran to $731,000 in October. Based on the time the money was employed, the rate of return was about 22% per annum. In both cases, the return is computed on an all-equity investment. I definitely feel some borrowed money is warranted against a portfolio of workouts, but feel it is a very dangerous practice against generals. We are not presenting TNP as any earth-shaking triumph. We have had workouts which were much better and some which were poorer. It is typical of our bread-and-butter type of operation. We attempt to obtain all facts possible, continue to keep abreast of developments, and evaluate all of this in terms of our experience. We certainly don't go into all the deals that come along. There is considerable variation in their attractiveness. When a workout falls through, the resulting market value shrink is substantial. Therefore, you cannot afford many errors, although we fully realize we are going to have them occasionally. Lessons from the Partnership Letters. Workouts. January 24, 1962. Our second category consists of workouts. These are securities whose financial results depend on corporate action rather than supply and demand factors created by buyers and sellers of securities. In other words, they are securities with a timetable where we can predict, within reasonable error limits, when we will get how much and what might upset the apple cart. Corporate events such as mergers, liquidations, reorganizations, spin-offs, etc. lead to workouts. An important source in recent years has been sellouts by oil producers to major integrated oil companies. This category will produce reasonably stable earnings from year to year, to a large extent irrespective of the course of the Dow. Obviously, if we operate throughout a year with a large portion of our portfolio in workouts, we will look extremely good if it turns out to be a declining year for the Dow, or quite bad if it is a strongly advancing year. Over the years, workouts have provided our second largest category. At any given time, we may be in 10 to 15 of these, some just beginning and others in the late stage of their development. I believe in using borrowed money to offset a portion of our workout portfolio, since there is a high degree of safety in this category in terms of both eventual results and intermediate market behavior. Results, excluding the benefits derived from the use of borrowed money, usually fall in the 10% to 20% range. My self-imposed limit regarding borrowing is 25% of partnership net worth. Oftentimes we owe no money, and when we do borrow, it is only as an offset against workouts. January 18, 1965. On a long-term basis, I expect the workouts to achieve the same sort of margin over the Dow attained by generals. January 24, 1968. As in other categories, we tend to concentrate our investments in the workout category in just a few situations per year. This technique gives more variation in yearly results than would be the case if we used an across-the-board approach. I believe our approach will result in as great or greater profitability on a long-term basis, but you can't prove it by 1967. January 18, 1964. In this category, we are not talking about rumors or inside information pertaining to such developments, but to publicly announced activities of this sort. We wait until we can read it in the paper. The risk pertains not primarily to general market behavior, although that is sometimes tied in to a degree, but instead to something upsetting the apple cart so that the expected development does not materialize. The gross profits in many workouts appear quite small. A friend refers to this as getting the last nickel after the other fellow has made the first 95 cents. However, the predictability, coupled with a short holding period, produces quite decent annual rates of return. This category produces more steady absolute profits from year to year than generals do. In years of market decline, it piles up a big edge for us. During bull markets, it is a drag on performance. On a long-term basis, I expect it to achieve the same sort of margin over the Dow attained by generals. As I have mentioned in the past, the division of our portfolio among the three categories is largely determined by the accident or availability. Therefore, in a minus year for the Dow, whether we are primarily in generals or workouts is largely a matter of luck, but it will have a great deal to do with our performance relative to the Dow. This is one of many reasons why a single year's performance is of minor importance and, good or bad, should never be taken too seriously. If there is any trend as our assets grow, I would expect it to be toward controls, which heretofore have been our smallest category. I may be wrong in this expectation. A great deal depends, of course, on the future behavior of the market, on which your guess is as good as mine. I have none. At this writing, we have a majority of our capital in generals, workouts rank second, and controls are third. Compounded wisdom. Workouts and other forms of arbitrage can be a highly attractive area for profits in their own right, and have the added benefit of diversifying the sources of annual gains in a way that protects overall results in down markets. They provided Buffett with an outlet for his energies when the overall market was high. Doing nothing when there is nothing to do can be a challenge for vigorous investors. Charlie Munger would say when he signed off on workouts in future years, "Okay, at least it will keep you out of bars." For Buffett, this has meant 20% a year average return. When stock prices rose, workouts comprised a larger amount of the capital. When opportunities to invest in generals abounded, the percent in workouts would shrink. Everyone can benefit from the diversification workouts offer, but workouts aren't something everyone is going to be comfortable doing. For the latter group, other outlets exist for investing that can produce high returns and are also not tightly correlated to the overall market direction from day to day. If you don't think workouts are right for you, privately owned businesses might do the trick. We'll learn more about a form of those called controls in the chapter that follows. Chapter 8. Controls. We do not want to get active merely for the sake of being active. Everything else being equal, I would much rather let others do the work. However, when an active role is necessary to optimize the employment of capital, you can be sure we will not be standing in the wings. January 20th, 1966. Picture a group of stodgy old men serving as members of a small public company's board of directors back in the late 1950s. This group had been getting together for a discussion and review of the business, a generous description of their activities, followed by fine cigars for many years. They found it all rather enjoyable. It was a simple-to-manage, easy-to-understand business, and no one asked too many questions or created too much extra work. Plus, they paid themselves generously. Shareholder value was low on the list of priorities, if it was on the list at all. Then everything changed when they learned that someone whom they'd never heard of had acquired 20% of the outstanding stock and now had effective control over another 20% of the company. Who was this guy? With control over enough stock to have a material say in its operations going forward, what was he up to? This is how I like to picture the beginning of the Sanborn Map saga, the partnership's first control investment. Just imagine the directors' expressions when Buffett turned up in 1959 for the first time. They must have been shocked at least twice. Once when they saw Buffett, as he was still in his late 20s, then again when he demanded a distribution of Sanborn's huge securities portfolio, alone worth $65 a share net, $20 more than the market value of the entire company. There is little doubt that the folks at Sanborn had no clue what they were up against with Buffett, at first. They would soon find out. Here's the full story from Buffett's letter dated January 30th, 1961. Two things to keep in mind as you listen to it. First, this was a tiny company. Book equity was only $4.3 million, or $35 million in 2015 dollars. Second, Buffett had more than a third of the partnership invested in this